Good morning, everyone. This is Darius Dell here, founder and CEO of 42 Macro, here to present our Macro Bundle Live Q&A for Wednesday, December 22nd, 2021. I'm joined with my friend Gordon Johnson, founder and CEO of GLJ Research, formerly of Lehman Brothers, formerly of everything you've seen on financial Twitter, finance media, man. How you doing, Gordon?
Hey, thanks for having me, Darius. I appreciate it.
Dude, it's great to see you, man. You're always so well, immaculately dressed, as is your research is immaculately buttoned up, man. So I'm sure our audience is really excited to dig into some of the micro themes you're talking about heading into next year. Obviously, we got the macro generally covered here. So without
Right.
further delay, let me just kick it off to you, kind of go over your overview.
Yeah, so I really appreciate you guys having me. I love what you guys do. I fervently read your stuff.
Thank you,
So
man.
I'm excited to be on the show. So just as a quick introduction, I'm the CEO of GLJ Research, founder. We have a team of about 5 people directly on our team, and we cover steel, iron ore, solar, electric vehicles, cannabis, lithium ion, and of course our favorite, the uranium sector.
Hi,
Um,
Beta.
yeah, yeah. It's there's been times this year where I couldn't sleep, and there's been times where I've gotten sleep. The times of sleep have been few and far between. But
Indeed.
so with that said, I just wanted to provide. I know you guys cover the macro, but I just wanted to provide kind of our overall macro backdrop. And I
Hmm.
think that there's two prevailing key themes right now, and one of those themes is there's a ton of money. If you look at the actual savings sitting on the sidelines that is prepared to be put to work as the COVID virus dies down, restrictions are lifted, and people can go out and spend again. And thus, there's one train of thought from a number of the smartest investors that we talk to that you're going to have record earnings next year, you're going to have record spending, and that's going to be driven by a lot of that money that's on the sideline when you look at the aggregated data. That's one train of thought. So that's a very bullish train of thought. And that yeah. So I'm sorry. Go ahead.
I agree with that.
So that's one train of thought. Then there's another train of thought that a lot of that money on the sidelines, when you look at the actual savings, when you define savings, all of that cash is not cash. This is factual. A lot of that cash is in stocks. A lot of that cash is in crypto. A lot of that cash is money that's went to pay down credit cards, etc. So the idea that that cash is going to be redeployed is incorrect. This is another train of thought, and you're not going to have that aggressive spending. And when you look at things like Apple saying in December that iPhone demand is weak, you look at the Philly Fed Index last week, that was very bad. You look at retail sales last week, very bad, specifically in the areas where consumers should be spending. You look at the data that came out today, the index data that came out today that disappointed significantly. And there's another train of thought that the stimulus is wearing down. The money has already been deployed via stocks, crypto, etc. And if the stock market were to sell off just 10%, or the crypto market were to sell off just 20%, all that there's basically $1 trillion of excess savings. All of that $1 trillion of excess savings will be wiped out. So there's another train of thought that that money's not going to be redeployed. Previously, you had a situation of $120 billion a month of Fed QE. You had positive GDP growth. You had rates at zero. And now you're going to have a situation of zero QE. You're going to have 3 rate cuts, and you're going to have slowing GDP growth. So there's another train of thought that things are going to be very bearish next year. So I wanted to set that up as those two trains of thought. The question then is, where do we lean? And right now we're looking at key levels in the S&P 500 of 4,500. This is on a macro basis of 4,500 and 4,700. And either way, if the market breaks below that level and or above that level, we think those are two key points to look at, both from a bearish and a bullish perspective. So we're looking to that, and we're majorly looking towards Q4 earnings and what companies are guiding for with respect to Q1. So I think that's the kind of broad macro backdrop, and we can get into specifically if you want to where we think things are headed. But I just wanted to provide that broad macro backdrop because I think those are the two trains of thoughts from the most intelligent investors we speak to. With respect, yeah, I'm sorry. Did you have a question?
No, I was just going to quickly say, when I have conversations, and we were having a conversation with a lot of the same institutional investors, that's exactly the discussion. And most of
Right.
the pushback I get in terms of so we have a forecast that growth is likely to decelerate, inflation is likely to decelerate throughout the balance of 2022. We've been doing extra work in the direction of, oh, are we going to slow below trend from a growth perspective? And I
Right.
think that's the one sort of key risk out there that I don't see in consensus forecasts. I don't see obviously in market pricing at the current juncture, but I think is actually on its way to becoming a more probable risk as a function of a lot of what you just outlined in the bear case. So I just wanted to chime in and sort of give our thoughts on that.
Right. Right. Do you mind if I use my computer, or is that okay? I'm just pulling up some
Yeah,
things.
no worries. No worries.
Sorry. Sorry. I didn't know if that was okay.
Not at
One
all.
second. Just want to
Yes.
pull up a couple of things here.
Yeah,
Uh,
while you're pulling that up, I'll quickly say, I mean, this is something going to slides 81. If Colin, if you could put the deck on the screen real quick while he's looking at that. Looking at slide 81 in this deck, we talk about this. I talk about this in every Zoom meeting I have, 3, 4 times a day, which is, look, yeah, we get this sort of this discussion about, hey, there's this, consumer excess savings, this balance sheet analysis that is effectively saying there's a train of demand, of aggregate demand that's being restrained and waiting to be unleashed next year. And clearly we can see this when you look at the wealth effect. How we calculate it is the household net worth in the U.S. as a percentage of disposable personal income. And clearly, if you look at the last prior peaks, we're basically double where we were, kind of in the last cycle peak. And so that's obviously, something that investors are citing. But then when you start to decompose where that wealth actually is, it's increasingly concentrated in the balance sheets of the upper quintiles of society, or the upper deciles of society. The top 10% of U.S. households own 65% of that wealth. The bottom 50 own 2% of that wealth. And so you think about 7% inflation, you think about real consumer disposable income at a down 300 basis points on a per capita basis on a year-over-year basis. To me, you have to wonder, like, why do these consumer survey indices look like they do, particularly the indices around financial conditions and the indices around consumer demand, consumers' willingness to go buy big ticket items like cars and houses and things of that nature. So I tend to lean towards the bearish camp. I don't know that the market's ready to price that in yet, because I don't think we're at that point in the process from a growth deceleration perspective for the market to start to have to price that in. But I do believe that's coming in maybe late Q1, early Q2.
yeah. So to that point, we agree with that. So I guess the index I was specifically referring to that came out today, the Chicago Fed National Activity number, last month 0.75, this month 0.37. So significant decline. And
Mhm.
like you said, when you look at real earnings, right? You look at the increase in average hourly earnings minus inflation. That number is sitting negative. You look at some of the inflation dynamics, right? So if you look at the 40% of CPI is apartment rents, right? It's the amount you pay effectively to rent your apartment, and that component of CPI is sitting at about 3% right now. Whereas in reality, we know that number is at 16%.
Yeah.
My point is, as those incremental CPI reads come out, we think the number is actually going to disappoint, i.e., it's going to be higher than expected. And I think that's going to shock people somewhat. And as you know, as you guys know better than anybody, inflation is very nasty and eventually leads to strikes in spending, and thus deflation. And one last thing I'll highlight, we're looking at this very closely, the Manheim used car index. It updates 2 times a month. Late November, used car prices started to fall. So we're very anxious to get the actual real-time data at the end of this month to see what used car prices did, to see if we're starting to see consumers actually push back on these increases in prices, which they haven't until now done. So I didn't know where you wanted me to take it from here. You want me to get specifically into kind of how we view the macro backdrop? Do you want me to talk specifically about some of our micro views? I didn't know
Yeah.
how you guys wanted to take the
No,
discussion.
we'd love to hear some of your micro views. So clearly, that's your sort of macro backdrop. How are you sort of helping investors kind of navigate that from the perspective of your sector, your subsectors of coverage? Because clearly, a lot of them are all high beta and would generally not necessarily fit as good places to be allocated to in that macro backdrop. But obviously, you might have some shorts that you might want to share, or some longs that you think are positioned well to weather that storm.
Yeah, so let me talk about one of the longs we like, and then I'll talk about one of the short sectors we like.
Mm.
So on the long side, we're extremely bullish uranium, and the reason we're bullish uranium is because if you look at what's happening in the geographies that have been very aggressive on renewables, be it solar, be it wind, etc. You're talking about Germany. You're talking about California. You're talking about Texas.
Yeah.
In Germany, over the past decade, their energy costs are up roughly 800% versus the rest of Europe. In California, it's a similar level. 2011 to 2020, their energy costs are up 8 times versus the rest of the United States. I'm sorry, the number in Germany is 400%. California is 800%. And then in Texas, you're seeing blackouts and brownouts due to at times where you have freezing weather, and thus maybe the natural gas and fossil fuel isn't as readily available. The wind and solar isn't meeting the needs. And effectively, when you have a switch from distributed baseload power to intermittent peak load power, what happens is that intermittent peak load power, solar and wind, is effectively not reliable because you don't know when the sun's going to shine, when you're going to have clouds, when you're going to have snowfall, etc. And you don't know when the wind's going to blow or not. So when you have to switch back to the distributed baseload power, grids effectively aren't set up for that. But given the virtue signaling from a lot of these governments are racing increasingly to shut down natural gas, coal, and nuclear powered plants. So in these countries where, in the states where this has been aggressively pursued, when you have this switching dynamic, the cost to go from, solar back to, fossil fuel and also import those fossil fuels in is exorbitant. So when people talk about, I had this argument with a guy from BNEF just yesterday. It got pretty heated. But when people talk about solar being cheaper than fossil fuels, it's almost laughable. You could literally give the solar panels away for free and it wouldn't be cheaper. The reason is because what people are doing is they're looking at LOCE analysis, levelized cost of energy analysis. And that effectively looks at the cost of solar, just the cost of solar power when the sun is at its peak height versus the cost of fossil fuels basically on average over the entire day. And that's extremely not analogous to apples because think about it, right? When the sun goes down, you have to switch to fossil fuels. To transfer that solar power back to the grid, there's energy lines. None of that stuff is included. So that's why, just very simplistically, when you look at the cost of solar or the places that have done solar wind aggressively, their prices, their energy costs have gone up significantly. And I think even this summer, you can look at what's happening with natural gas prices in Europe. It's ballooning. Electricity costs are ballooning. I'm in Germany. I'm hearing that. So the point is, I think that there's going to be a real need to have a real answer, right, to zero CO2 energy. And I think nuclear is the answer to that. So if you take a look at what's happening in nuclear, since Fukushima, nuclear has been a 4-letter word. So what's happened? A bunch of capacity has been shut down. You effectively have the two low-cost producers, Kazatomprom and Cameco, buying material in the spot market to meet their needs. And as a result, if there's just a modest uptick in demand, we think there's going to be a significant increase in uranium prices, the commodity uranium, which we think will drive the uranium stocks higher. So when you add to that backdrop, you have guys like Sprott who are in the market using at-the-market equity issuances and capital issuances to go out and buy spot uranium availability, thus taking spot uranium out of the market. They're effectively forcing the price up. So the big catalyst, in our view, is going to be when the big uranium producing plants re-up their annual contracts, which we think is imminent. And when that happens, we think there's going to be a big catalyst for the space. So we think there's a fundamental catalyst in that you have a massive supply-demand imbalance that's being driven by guys like Sprott coming in and taking product out of the market. And we think you have a sentiment catalyst in that as the winter gets colder and you have issues in Europe and the United States and more brownouts and blackouts all over Europe and in places like Texas and California, we think politicians are going to have to shift course. We've seen it in Belgium. We've seen it in France where they're keeping nuclear plants online longer than expected. You're starting to see it in the United States. I think Biden was the first one to have nuclear in his energy plan over the past 4 decades. So we think that there's going to be a sentiment push. So we like the uranium space. Now, taking a step back, the solar space, which was very strong last year and all the way through basically the last 3 months prior to where we're at right now this year. But we've cautioned all along that the Green New Deal was going to be significantly watered down. We've cautioned that China was not going to be as big a market this year, and we believe next year as people thought. And most importantly, we caution that if you look at all the capital, the quote unquote free capital that all these solar companies had raised over the past 2 years to ramp capacity for which there's no demand, we caution that prices were going to collapse. So we're very negative overall on the solar backdrop. We think that there's a massive oversupply of polysilicon, solar wafers, solar cells, solar modules. And we think that if you look at the distribution of ratings, for instance, we initiated Daku around $66 with a $30 price target. Stocks around, I think, $36, $38 right now, but it's like 12 buys, one hold, one sell. We're the sell. I think the reason why we highlight that is not to pat ourselves on the back. The reason why we highlight that is to highlight the street is overwhelmingly bullish, a sector that's currently defined, a commodity sector that's currently defined by structural oversupply. And in commodity markets, when supply is in excess of demand, the price equals the marginal cost of production. The marginal cost of production for polysilicon is about $6 to $8. Prices are sitting at 30 right now. If prices go from 30 to 10, the solar sector is going to get, in our view, annihilated. When we say the solar sector, we want to be very specific. The component parts manufacturers, the Jinkos, the CSIQs, the Dakus, etc. Now, there's a rooftop solar sector, completely different. But what's happening there is California, the poster boy for solar globally, has decided that rooftop solar is not fair to poor people. Let me explain. Basically, what they're saying is it costs about $20,000 to put a rooftop solar system on your house, right? Mm-hmm. You put that on your house, you basically don't pay for electricity. What happens is the utility takes that price and then redistributes it to everyone else. So it's effectively a regressive tax on the poor. We've made this argument since 2009, but California, via the CPUC, just recommended a new NEM, net metering rule that basically addresses that and shifts the cost back to the rich/solar manufacturers. That's very negative for the rooftop space. The stocks are priced for tremendous growth. We think if this passes, even if it passes not in the current form, but a slightly reduced form, we think it's bad for rooftop solar names. So we think next year, we think the guys like Sunrun, the guys like SolarEdge, the guys like Enphase, the guys like some of these other rooftop solar names are going to come under tremendous pressure. So we think 2022 is going to be the year that solar stocks sell off. So we have a number of sell ratings in the solar space. Conversely, we like First Solar. Let me tell you why. Now, Build Back Better, clearly Biden got rid of it. Or I'm sorry, Joe Manchin, quote unquote, got rid of it. Now, there's some rumors that they're going to try to do another Build Back Better. Our government contacts say it's possible, but it's going to take a lot of negotiation. But in the Build Back Better bill, they had a specific allocation for First Solar that effectively would have put 15 cents of taxpayer money towards every solar panel they make in the United States. That means that their cost was 20 cents. Taxpayers were going to pay 15 cents of that. Now, that didn't pass, but our point is First Solar has strong lobbyists, and the government in the U.S., for some reason, and always has, likes First Solar. So we think as the Chinese are disadvantaged from all the tariffs, from all the oversupply, et cetera, we think the U.S. is going to favor the U.S., the quote-unquote U.S. companies, and we think First Solar is favorably positioned. So on a relative basis, we're very negative solar, but we think First Solar outperforms.
Awesome, man. That was outstanding, man. I love your passion too. You're very much like me. You would do this for free. I'd go back and maybe not play O-line if I could play quarterback or something. I'd play that for free. But no. Before we turn over, you got some questions for you in the queue. But before we do that, let's summarize. So you're positive on the uranium space, negative on the solar space, but you do believe that First Solar should stand out as both an absolute performer and a relative performer as well.
Yeah, and look, I'd be remiss if I didn't. Everybody wants me to always talk about my views on the EV space. So let me can I just briefly address?
Of course, man. You're famous for these views.
look, and everybody thinks we're negative. I also want to say we love the steel stocks. Hopefully, if we have time, I want to get into that. We like U.S. Steel. We like Cleveland Cliffs. We think they're going to outperform don't necessarily think the management teams at one of those companies is the best, but we like the stocks. But just quickly on the EV space. Now, listen, we're very negative Tesla, and the reason is because Tesla's been around since what 2011. They've had almost a decade to show performance in the U.S. They've been given billions of dollars in taxpayer subsidies, and they're still only selling I think it's like around 200 or expected to sell around 200,000 cars in the United States. They're less than 3% of market share. The reason why we say we don't like it, it's not that we don't like Tesla. We're just looking at stocks. We think the stock is grossly overvalued. We think if you look at China, BYD now sells the most EVs in China. They're now the EV leader. In Europe, VW is now the EV leader. It's no longer Tesla. Tesla's market share in China has went from about 22% to 12%. In Europe, it's went about from 30% to 12%. So when you introduce competition into a market, quote unquote, the dinosaurs, they dominate. And in the U.S., Ford and GM are coming aggressively for Tesla's neck. Now, keep in mind, we believe that Tesla still loses a significant amount of money selling EV cars. The reason why it doesn't appear so in their financials is because Tesla does not disclose what the economics are on their Chinese facility. If you look at the 2020 10K from Tesla, China was about 20% of their revenues, yet only roughly 4% of their long-lived assets. So how can a company or a country that's only 4% of your long-lived assets produce 20% of your revenues, yet the debt for China was only 616 million, which was around, I think, 3% of their debt. So what that tells us is either the Chinese government is providing Tesla a number, this is our view, this is an opinion, a number of off-balance sheet funding that we don't see, or that those financials need to be revealed. So we think that if you broke out the actual fundamentals of the plants, right? I think that what's happened in China is all of the costs associated with Tesla's China plant have been significantly back-end loaded. I think Tesla is very indebted to China from that perspective. And I think if you looked at the actual profitability on a plant-by-plant basis, if you excluded that China plant from the economics, I think that Tesla would be a loss-making company. So when you consider that there's big competition coming from dinosaurs who make millions of EVs profitably, right? VW, they sell about 11 million cars a year. GM, 5 million. Ford, 4 million. Tesla sells about 900,000 cars a year. And the dinosaurs do it profitably. So now that you have GM and Ford coming aggressively for Tesla in the U.S., you consider Tesla has no technological advantage. They're last in full self-driving, according to Navigant. They buy their batteries from CATL primarily in China. Anybody can buy those batteries, and they're China-made. They have no more over-the-air update advantage. And by the way, GM is ranked number one in full self-drive via Cruise, and Ford is ranked number two via Argo. Ford has agreements with Walmart, etc. So I just think that like this fluff around Tesla is going to come tumbling down next year. Now, with respect to deliveries, I believe the street is intentionally sandbagging 4Q21 deliveries. I think the number is going to come in around 280,000. The street's at 265. And I think the earnings in Q4 are going to be good, better than the street's estimates, because the street is underestimating earnings. And you've had an auto shortage where automakers across the board are going to report stellar earnings because they're raising prices significantly. But as you move into next year, I think there's big risk around Tesla hitting their $1.5 million mark. I think there's tremendous legal risk with respect to them selling FSD, with respect to the fires, with respect to a number of other items. And I also think there's significant sentiment risk. And you can see that with respect to Elon Musk selling stock. He sold a significant amount of stock. So we're very negative over the long term on Tesla. Near term, we think there's two positive catalysts coming: delivery beat, earnings beat. But then through 2022, we think the stock is going to come down. We think significantly as it becomes clear that they're not the growth engine, they're not the leader in the EV space. And if they're forced to detail those financials in China, which we think PricewaterhouseCoopers should absolutely make them do, so investors can understand what they're investing in. We think that the cloud around this company could turn out to be a storm. With respect to EVs overall, that's all anybody wants to talk about. But keep in mind, electric vehicles are only 3% of global auto sales. 3%, right? 3% of global auto sales. And in the US, electric vehicles are roughly 2%. Only reason they're 3% globally is because governments force you to buy EVs. If you don't, you get hit with a penalty as an automaker. So the automakers are being forced to make these things. We think that there's great technology in hydrogen. We think there's great technology in other areas. So I don't know if EV is going to be the answer. So I think that people need to significantly temper their expectations because there's just not enough lithium in the world for every car to go EV. And I can't guarantee you, but I bet at some point, right? I'm sitting in Germany right now. I bet at some point this year, somewhere in Europe, is going to tell their EV drivers to stop charging their cars because you just don't have the energy. Because when you do dumb energy policy of switching from reliable fossil fuels to unreliable solar and wind, and then you force everybody to have cars that you need to plug into your into your socket, it translates into disaster. California did that last year. They asked people to stop plugging in their cars. I think it's going to happen in Europe this year, and I think politicians are going to be forced to take a step back. Listen, Elon Musk did not make EVs popular. Socialism by Western governments did. Basically saying if you don't buy an EV or if you don't make an EV as an automaker, we're going to penalize you. And yet and still, despite all that socialism, still just 3% of auto sales. So I think that if you look at the market caps, you would think that EVs are over half of auto sales. I asked my mom the other day, hey, what do you think EVs are? She's like, what is it, 70%? No, it's 3%. So I think people need to keep that in mind.
Dude, this is you got so many comments in the queue, man. Everyone loves your passion. I certainly do. I appreciate it. Before we actually open up the queue, give me your so heading into next year, give me your top 3 long stickers, top 3 shorts.
Top 3 longs, we would go with Chemico. We would go with First Solar. And I got to throw 2 more in there, US Steel and Cleveland Cliffs for different reasons. We can talk about those if we have time.
Yeah. And then on the short side?
On the short side, we would go with Daku. We would go with Daku. We would go with Jinko. We would go with Sunrun, and we would go with Tesla.
Oh, love it, man. Dude, your ability to go back and forth between all these topics is world class.
Oh, we didn't even talk about cannabis. If we have cannabis. Well, good.
I'm gonna make people come subscribe to your research.
Price targets on Tilray and ACB. We think. Let me just say this real quick for everybody out there who loves these cannabis companies. When Tilray or any of these other Canadian cannabis, that's where we think the real short money is to be made. Talks about they're expanding into other geographies. It's like, this is a true story. I don't want to say which company said we expanded into Poland. You go in, you do the due diligence, the country of Poland. It was literally one person that was buying cannabis from them. But when they said it on their conference call, they made it seem like they're expanding into the entire country. My point is, be very diligent in the due diligence you're doing when these companies talk about expanding into other countries. It's illegal to produce cannabis in Canada and sell it outside of Canadian shores. So any company that says that, we think you need to do the due diligence. There's other points to be made there, but I think that's an important one.
This is excellent, man. Awesome. So got a question in the queue from David Wessinger. How you doing, David? Any thoughts on carbon credit market?
Yeah, I mean, I think that that's a market that people are definitely looking at. We haven't looked at it. We haven't done a ton of analysis on it because it's so new. But I think initially it'll be a market where you see massive upside, probably followed by some significant swings lower. So if there's ways to invest now, we would probably be biased to the long side on that sector.
Absolutely. And then you might have mentioned this, but do you favor a particular stock or the actual physical commodity with respect to uranium?
Yeah, I mean, to be honest with you, if I had to pick, I would probably be long the commodity first and the stock second. But we think the stocks are going to be high flyers. Now, our uranium call is a longer term call. Admittedly, we Cameco went way higher since we initiated on it. But we think there's another leg up as the contracts start to renew. But yeah, I would be long the commodity first and the stock second.
Gotcha. Thanks. That was a good question from Jeff. John's asking, how many decades does it take to permit and build a nuclear power facility?
That's a great question. That is a great question. So it takes about 5 to 10 years. So that's one of the key bear arguments. But what I would highlight to him is if you look at the amount of uranium that just Sprott has purchased over the last year, it equates to multiple new uranium plants. So my point is, these asset acquirers are doing is they're forcing the needle, if you will. So it does take a long time, but these guys who are doing these ATMs using a capital markets to go out and acquire physical uranium are effectively building multiple new plants right before our eyes.
Gotcha. We gotta. You already think you gotta have a new customer after this, my friend Adam from Red Bank, New Jersey, saying he wants your research and whatever your chest day routine is. Mine certainly isn't what it used to be, but certainly man, I keep in good shape, my friend. All right, wrapping up, we'll try to keep these things around a half an hour. So, we had a couple questions in the queue for macro specifically. So, you might have thoughts on this as well, but I know you have macro views as well. But and in fact, before we even ask the question, one tweet that really stood out for me from you in recent weeks was sort of you made a call. Someone asked you why was the 10-year yield not breaking out in the
Right,
context of QE and all this stuff, and or
right.
QT and everything else. And you effectively made the comment that, hey, look, these guys have lost credibility. The market knows that if the stock market's down 5 or 10%, these guys are going to come back and pivot dovishly again. And you tweeted that before the December 15th FOMC meeting when Powell effectively confirmed that on the Q. So hats off to you for kind of nailing that. Any additional thoughts there?
Yeah. So look, I have this written down. I knew you were going to ask this question. So I think, look, this may sound aggressive, but let's just look at the facts. I think the Fed is purposely falsifying the bond market's inflation signals. So you think about it, the Fed, part of the Fed's Treasury security holdings are, Treasury inflation protected securities.
Yeah.
The Fed holds tips with a face value of around 381 billion right now. So if you think about it, right, with these tips purchases and holdings, the Fed has not only repressed the tips yield, but also has, manipulated the bond market's inflation expectations data that are based on the difference in yields from Treasury notes and tips with similar maturities. So if the Fed is in there buying, right, and we know the Fed doesn't trade, they buy and hold, buying tips, then the inflation data we're using to basically gauge what the market's expectation is being intentionally repressed by the Fed. So, the often cited, inflation expectation data coming out of the bond market, the 10-year break-even inflation rate, which is sitting at 2.38%, it's not an indication of actual inflation expectations by the bond market. It's simply what the Fed wants it to be, right?
I,
So I think that for everybody who's saying, well, the bond market's saying inflation's not going to be high, I think that's grossly misunderstood and misrepresented because if the Fed stepped out of the market, I think the bond market would be saying something much different. And you could actually say the same thing for MBS, right? The
yeah.
Fed is effectively buying $110 of MBS a month. 40 billion they're adding to their balance sheet, and 70 billion they're using to replace pass-through principal payments. So by buying $110 billion a month, they're the biggest buyer of MBS in the market. And we know that the Fed doesn't trade, so they just sit on that thing. So what they're doing effectively is they're repressing not only the interest rates on mortgages, but also yields in the broader bond market. So for people who are saying, the yields aren't going up, so inflation is not a problem, that's a big misconception. And I saw a chart the other day. I looked at the 10-year yield going back to, I think, 2009. And it was like the same rate it is today, and saying the 10-year predicts the S&P. And clearly S&P is like, more than double. So I think that everybody that's using the bond market to try to predict stocks, I think is wrong. And I think the major reason is because the Fed is manipulating bond prices.
Yeah, look, I try not to get tinfoil hatty. I take everything as it is. If it's a time series, it is what it is. You just have to acknowledge the change in the time series. But the one thing that kind of stands out to me, if you want to go down this rabbit hole, which is the gold price. I mean, if you look at sort of just a simple linear regression between the 10-year tip yield, which obviously is being manipulated by the Fed, and the gold price, even that would be north of 2,000 by now. And so if you think about, okay, where would the Fed, if you had a central bank that was hell bent on making sure that they got everybody who lost their job in the pandemic back to work, and they were going to sacrifice it on the inflation front in order to get that done, to achieve that mandate, well, where could they depress inflation signals from financial markets to give them additional scope to go down, to continue to achieve these policy objectives. And clearly, 10-year tips yield, or the tips market in general, but also the gold price. I think they were leaning on the gold price, and I think the probability that they stop leaning on the gold price will actually rise as inflation peaks and rolls over. But that's more of a Q1, Q2 event. All right, last question here. What are you? I guess it's for me. You can take it as well if you want. What are your thoughts? John's asking, what are your thoughts on the dollar going into 2020? Seems like the risk of investing in equities for the remaining window seems very risky. John is certainly onto us in that regard. I mean, you look at our back test on slide 40 here, in the grid asset market back test. Dollar's a good buy, particularly heading into the deflation regime, the style of deflation that we have projected. That we highlight in our grid asset market back test. And so right now, dollar is actually probably the best currency signal out there. If you think about transitioning to that overall deflation regime, we're currently in deflation now from a market regime nowcasting perspective. I happen to think we might bounce back into grid zero. This is something we talked about in the leadoff morning note today. For those of you that had a chance to check that out, but we do believe you're going to be able to have an opportunity to stay long U.S. dollars well into the middle of next year. Eventually, the Fed will have to sort of pivot backwards, or at the bare minimum, ease up on its policy tightening initiatives as a function of a slower, deeper than expected slowdown in growth, or a potential deeper than currently anticipated drawdown in risk assets. We know, Gordon, to your point, we know what the Fed's trained us all to do and anticipate whenever we see some stumbling in either of those respects.
Yeah, from my perspective, I got the dollar call. I won't lie, dead wrong. So I don't want to opine there. I'm not a currency specialist. I lost a ton of money personally trying to bet on the dollar this year. So I don't know. I really
don't kick yourself, man. A lot of institutional investors have gotten the dollar call wrong this year. We put it on back in early June as a hedge. And ultimately, it turned out to be quite a good vehicle. I believe our dollar trade is up more than the S&P since we put it on. So that's a pretty.
But it's been my partner, my chief investment officer. It's been his biggest gainer this year, so he got it right. I thought he was dead wrong and bet accordingly. I was wrong.
Hey man, this is it's the name of the game. We're gonna get stuff right. We're gonna get stuff wrong. As long as you limit the size of your losses and the frequency of them, you're gonna be staying in the chair. So we got one last final question, not a question, but a comment. John Beck is saying, great guest, love the content, love the enthusiasm. Make sure he comes back. So obviously you represented yourself and your firm very well today, my friend Gordon. Appreciate you.
Hey, thanks, man. And again, I appreciate you and value your stuff. Keep it up.
Yeah, likewise, man. Everyone have a happy holidays. We'll catch you back here on the other
Merry
side
Christmas, everybody.
Cheers.
All right.